Douglas Holtz-Eakin right now, the former director of the Congressional Budget Office. Doug, this kind of language we're hearing is typical of those at the Federal Reserve, those in power in Washington, to say the banking system is sound, the underpinnings are good. I get that. But do you have any worries, especially when a Silicon Valley bank goes off, for a song? You could argue that First Republic as well, propped up for a song. And even the Credit Suisse situation with UBS, UBS got that not only on the cheap, but almost for free. So you could start saying, rescues though these might be, successful mergers to avoid a panic though they might be, they are reminding you that they're kind of built on a bunch of matchsticks, aren't they?
Yeah, well, certainly you hope that these are isolated events and that we're now seeing something that you should see in every industry, which is when firms fail, other firms are there to take that and reuse that capital and use it more productively. The real question, Neil, is whether there is something systemic out there. We saw a lot of demand for discount window borrowing and this new term lending facility the Fed put out. That's an indicator that other banks are at least nervous about having their depositors show up and demand their cash. So that's the piece that's worth watching. If that doesn't transpire, if this really is the end of the troubles in the U.S. banking system, then I think on balance we've come through with the same risk of recession that we had before. I mean, it is true that banks will be more cautious, and at any interest rate they'll make credit less available. But it's also true that interest rates have come down. We've given up about 6 months of Fed tightening since the banking turbulence. And so on balance, financial conditions look about the same. And if you thought there was going to be a recession before, you probably should still think that. And if you thought the Fed was going to engineer a soft landing, they still have a chance to do that. So I haven't seen any market scarring in the real economy yet, but it's still worth watching the banking sector.
We're still watching where we stand on this debt ceiling impasse here. They're not going to raise it until they get concessions. That is, Republicans will talk to an influential Republican Congress on that part. But is this bank, volatility, calmer today, to your point, adding any kind of speed to these talks, or how would you describe it?
I haven't seen any discernible change in sort of the urgency surrounding getting the debt ceiling addressed. And, quite frankly, Neil, it's something that has to happen. And I leave it to the politicians who are elected to deal with this to figure out how. But politics is supposed to be the art of getting what has to happen done. And we're not seeing any real progress on that front. So I hope that more work goes into this from both the White House and the Congressional end very soon. If we, face additional bank volatility, a debt limit crisis would be the last thing we need. We also have to fund the government at the end of the year. We know that's always been a difficult task in recent years. So there's a lot of policy risk coming out of Washington that would layer on top of these underlying banking woes if they prove to be more systemic. That's not a combination we need at this point.
This is not something that will immediately take up, but there was some confusion out of the Treasury Secretary last week talking about banks and extending more generous deposit guarantees. She kind of tried to let people with, we'll take this up on a case-by-case basis. I think that was how it was finally concluded. But everyone's confused. Does that mean the government's going to be there as an ultimate backstop to raise these minimums should there be a run from these regional banks? That does not seem to be as much of a risk this week as it was last week. What do you think?
Well, it certainly is the case that the Dodd-Frank law made it necessary for Congress to act to get coverage of all the deposits. And the only way they got around that was to declare Silicon Valley Bank a systemically important bank, which it was not and is not. And they used that loophole. But that raises the specter of using that loophole in any circumstance, and there's nothing the Secretary has said that has given anyone firm guidance on when and under what circumstances they will use these extraordinary powers. And that's exactly the opposite of what Dodd-Frank was supposed to accomplish. It was supposed to tie the hands of the regulators, make them follow a playbook in the crisis so that everyone knew what would happen and they could manage their affairs accordingly. They were going to have living wills that told us how to wind down large banks if necessary, and we're worlds away from what the intent was. And we're back to a world where no financial market participant knows exactly what the government will do next, and that's not a great place to be.
That's an interesting one. That is not a great place to be. You're right about that. Douglas Holtz-Eakin, great seeing you again.
Thank you.